Stop. Before you put another dollar into VOO, you need to see something. Because right now in 2026, something is happening that hasn't happened in years. The fund that everyone called boring, slow, your grandfather's investment, it's quietly beating the S&P 500. Not by a little, by 7 full percentage points. As of this recording in June 2026, SCHD is up about 17% year to date. VOO is up about 10%. And here's what should actually bother you. The people who switched out of SCHD into VOO over the last few years because VOO always wins, they've spent this year watching that gap swing the other way. That's real money, real returns, gone because of one assumption nobody questioned. Now, maybe you're thinking, 1 year doesn't mean anything. And you're right to think that. That's exactly why I went back and ran the full 10-year history of both funds side by side through bull markets, crashes, rate hikes, everything. Because the only way to know if 2026 is the start of something real or just a blip is to understand why this is happening. By the end of this, you'll know which fund actually won over 10 years, which one wins right now, why they're suddenly moving in completely opposite directions, and the part most people miss entirely, which one actually belongs in your account. Because the answer is not the same for everyone, and getting it wrong is expensive. Let's get into it. Most people treat SCHD and VOO like they're basically the same thing, just two index funds, slightly different flavor. That's the first mistake. VOO is the Vanguard S&P 500 ETF. You buy it, you own the 500 biggest companies in America. Apple, Microsoft, Nvidia, Amazon, all of it, in one click. It's the default. It's what people mean when they say just buy the market. Over $1 trillion sit in it. The fee is almost nothing, 3 cents per $100 you invest. SCHD is a completely different animal. It's the Schwab US Dividend Equity ETF, and it doesn't try to own everything. It owns around 100 companies picked by a strict set of rules, businesses that have paid dividends for at least 10 straight years and then clear a strict quality screen, strong balance sheets, and real cash flow. Think less flashy growth rocket and more companies that mail you a check every single quarter without fail. Fee is 6 cents per 100, still incredibly cheap, just double VOO's. Here's the analogy I want you to hold in your head for this entire video, because it captures everything. VOO is a Formula One car, built for one thing: raw speed on a clean, dry track. When conditions are perfect, nothing on earth touches it. It is a machine engineered to win, and on the right day, it wins by a mile. SCHD is a Land Cruiser. It will never win a drag race. That's not what it was built for, and expecting it to would be absurd. But when the road turns to mud, when a storm rolls in, when the smooth track becomes a goat trail up a mountain, the Land Cruiser keeps grinding forward while the race car is spinning its wheels in a ditch, going nowhere. Here's the part people miss. The F1 car isn't better than the Land Cruiser. The Land Cruiser isn't safer in some universal way. They're built for completely different roads. Asking which one is better is like asking whether a race car is better than a truck. The only honest answer is better for what? 2026, as you're about to see, turned into exactly the kind of muddy, uncertain road where the Land Cruiser was always going to shine. And for a solid decade before that, the track was bone dry and the race car ran away with everything. One more number before we go further, and hold this one because it becomes the heart of the whole decision later. SCHD currently pays a dividend yield of about 3.3%. VOO pays about 1%. For every dollar you put in, SCHD hands back about 3 times the cash income that VOO does. We'll come back to why that matters enormously, but first, let's talk about who actually won over 10 years. And look, I know what some of you are thinking right now. The 10-year number is going to show VOO won, and this whole video is just hype about one good year for SCHD. Fair. Let's actually look at the real numbers, because the truth is more interesting than either side wants to admit. I'm gonna be straight with you here, even though it cuts against the exciting story I opened with, because credibility matters more to me than hype. Over the last 10 years, VOO won, not by a little, by a meaningful, compounding margin. VOO returned roughly 15.5% per year on average. SCHD returned about 13%. That 2.5-point gap sounds small. Over a decade, compounding, it absolutely is not. Put real dollars to it. $100,000 in VOO 10 years ago grew to roughly $427,000. The same $100,000 in SCHD grew to about $336,000. That's a gap of around $91,000. Same starting money, same time, doing nothing but waiting. So if the only question is which one builds the biggest pile of money over a decade, the honest answer, based on the last 10 years, is VOO. I'm not going to dress that up. But here's where one number can quietly lie to you. That 10-year win for VOO didn't come from 500 companies all pulling their weight evenly. It came almost entirely from a handful of tech giants, Apple, Microsoft, Nvidia, that went on a historically rare run. Because VOO weights by company size, those few names dragged the entire fund higher, while hundreds of other companies in the index were just along for the ride. Picture a relay race where one runner is a world-class Olympic sprinter and the other three are just decent, nothing special. The team wins gold, but not because it's a great, balanced squad. It wins because one freakishly fast runner made up for everyone else. That's been VOO for the last decade. The trophy is real, nobody can take it away, but it was won by a few superstars at the very top of the lineup. And that creates a hidden risk that the 10-year number doesn't show. When a handful of companies make up such a huge slice of the fund, you're not as diversified as you think. You own 500 names on paper, but a small group at the top is doing most of the heavy lifting. When they're running, it feels unstoppable. When they stumble, there's a lot less underneath you than you assumed. Meanwhile, SCHD spent a lot of those same years being mocked. While tech was flying, SCHD looked slow and boring. Investors who held it in 2023 and 2024 watched the S&P 500 sprint into the distance, while their dividend fund crawled. In 2025, SCHD returned roughly 4%, while the broad market ran circles around it. That was real pain, real years of feeling like you picked the wrong horse. But this isn't the first time the script flipped. Go back to 2022. The market had one of its worst years in over a decade. Tech got hammered, growth stocks sold off hard, and SCHD down about 3%. That year, the boring dividend fund crushed the mighty S&P 500, not by being exciting, but simply by refusing to fall apart when everything else did. So when people act like SCHD's 2026 run is some shocking, out-of-nowhere fluke, it isn't. We've seen this movie before. SCHD lags for years when tech is on fire, and then it shines exactly when the market gets scared. That's not a glitch. That's the entire design working as intended, which leads to the real question of this video. Why is it happening right now, in 2026? Because once you understand the why, the whole picture changes. Here's the thing. Understanding what's driving this gap in 2026 isn't just interesting background, it's the actual key to knowing whether you should be making any moves right now, because a lot of people are about to do something that's going to cost them. Stay with me. In 2026, the engine that powered VOO for a decade, big tech, finally cooled off. The economy started slowing, inflation came back, geopolitical tension rose. And when investors get nervous, they do something very predictable. They rotate. They pull money out of expensive, high-flying growth stocks and move it into steady, profitable companies that pay cash today, out of the race car, into the Land Cruiser. Here's why that rotation actually happens. And once you get this, you'll understand every market cycle like this for the rest of your life. When the economy is booming and money is cheap, investors are willing to dream big. They'll pay almost any price for a fast-growing tech company because they're betting on enormous profits years down the road. But when the mood turns, when rates are high, inflation is biting, and the future looks uncertain, those distant dreams start feeling risky. Investors stop asking, how big could this get someday, and start asking, what is this actually worth right now, and will it pay me while I wait? That second question leads them straight to healthcare companies, consumer staples, the businesses that keep selling no matter what the economy does. People still buy toothpaste in a recession. They still fill prescriptions. They still pay their utility bills. And those are exactly the kinds of companies SCHD is stacked with. So while the S&P 500 sits at around 10% year-to-date as of June 2026, SCHD has climbed to about 17%. That's the gap. It's not luck, it's exactly what this fund was designed to do when the weather turns. Here's the clearest way to picture what happened. For 10 years, the tech tide was coming in, and it lifted VOO higher than everything else. SCHD sat there, lower, looking like it was missing something. But in 2026, the tide started going back out. And when the tide goes out, you find out who was standing on solid ground the whole time, and who was just being carried by the water. There's one more piece of data that makes this real. Normally, SCHD and VOO move pretty much in sync. When one goes up, so does the other. The technical term is correlation, and historically theirs sits around 0.8, meaning mostly in sync. This year, that number dropped to around 0.3. In plain English, they've stopped moving together. They're now being pulled by completely different forces. That almost never happens, and it's the clearest signal that this rotation isn't just noise. And SCHD didn't just get lucky timing. It reshuffles its holdings every March, the way it always has, and its lineup stays anchored in steady cash-generating names like Texas Instruments, Qualcomm, United Healthcare, and Procter & Gamble, exactly the kind of companies the market started rewarding this year. Partly timing, mostly its rulebook just doing its job. So SCHD is winning this year, and now you know exactly why. But here's the trap that's quietly setting up right now, and it's the thing I most want you to hear before this video ends. Because right now, all over the internet, people are looking at that 17% number and getting ready to make a move. And I want to walk you through exactly why that move, as tempting as it feels, can quietly hurt you in a way you won't see coming. The instinct people have right now is to sell VOL and pile into SCHD, chase the winner. And I get it, it feels logical, the data is right there, why would you keep holding the underperformer? Here's what that instinct forgets. The same rotation that made SCHD shine this year can reverse. If tech catches fire again, if the economy re-accelerates and growth comes roaring back, SCHD will go right back to lagging and VOO will pull ahead exactly like it did for most of the last decade. Performance chasing means you buy the thing that already went up right before it cools off and sell the thing that's about to have its turn. You end up one step behind every single time. Think of SCHD and VOL like a winter coat and a summer shirt. Right now, in the cold snap, the coat is obviously the right call. You'd be crazy to wear the shirt, but that doesn't mean you throw the shirt away because summer is coming back. It always does. The smart move isn't to own only what works today, it's to own both, so you're never caught out when the season changes. And this is where the yield number comes roaring back because it reveals what these funds are actually for. Forget the price chart for a second. SCHD pays about 3.3% in real cash dividends. VOL pays about 1%. On a $300,000 portfolio, that's the difference between collecting roughly $10,000 a year in income versus about $3,000. If you're retired or getting close and you want your portfolio to actually pay you to live, that gap isn't a small detail, it's the entire decision. There's one more layer to the income story that makes SCHD genuinely interesting for the right person. It's not just the yield today, it's how that yield has grown over the years. SCHD's dividend hasn't just sat flat over the years, it has climbed year after year, growing substantially across its history. Think about what that means for someone holding it long term. The check you collect doesn't stay the same, it tends to get bigger every single year, even if you never add a single dollar. Buying VOO is like buying a plot of land you expect to be worth a lot more when you eventually sell it someday. Buying SCHD is more like planting an apple tree. In the early years, it's easy to feel like the land is the smarter buy, it's appreciating, it looks impressive on paper, but the tree keeps growing quietly, and every year it drops more apples than the year before. Instead of having to sell slices of the tree to eat, it hands you fruit on a schedule. You still want the whole orchard, price and dividends together, to grow over time, but the cash shows up without you deciding what to sell and when. For someone who wants their money to feed them, not just grow on a chart, that's a fundamentally different and often far more comfortable way to own stocks. Fair caveat, because I promised honesty, SCHD's most recent dividend growth has slowed compared to its early years. It's not a magic money tree that grows at the same pace forever, but the core idea holds. It's built to pay you meaningful, generally rising income in a way VOL's 1% yield simply isn't designed to do. Let's bring this all together, and I'll give you the same answer I'd give a friend, not the one that gets dramatic clicks. Both things from this video are true at the same time. Over the last decade, VOL compounded faster and built more wealth total. In 2026 and in rough years like 2022, SCHD held up far better and paid you more cash the whole way. VOL is the wealth-building engine for your growing years, and SCHD is the income engine for the years you want your portfolio to pay you back. Neither is wrong. They're answers to different questions. So here's a simple way to figure out which fits you. If you're younger, 20 or 30 years before you need this money, and you don't need income right now, history says VOL has been the stronger growth engine, as long as you can stomach the bigger swings when tech sells off. Time is on your side. You've got years to ride out the rough patches. If you're closer to retirement or already there and you want your portfolio generating real cash, SCHD's 3 times higher yield and its habit of holding up better in downturns do exactly what that stage of life calls for. Pay you now, hold steadier when markets drop, let you sleep at night. And for a lot of people, probably most, the real answer isn't picking one at all. It's owning both. Let VOL be your growth engine and SCHD be your income and stability anchor. When tech is flying, VOL carries you. When the tide goes out, SCHD holds the line. You stop trying to guess which season is coming and you just stay dressed for both. That's not exciting advice, but the boring, unglamorous strategy is usually the one that actually works over a lifetime. What I gently steer you away from is the move the headlines are pushing right now, ripping everything out of one fund and slamming it into the other because of one great year. That's not investing, that's chasing. And chasing is how solid investors quietly turn into mediocre ones. One more honest note before we wrap. Everything we looked at comes from a historically strong decade for US stocks overall. That may not repeat at the same pace. Past performance genuinely does not guarantee what comes next. Treat all of this as understanding, not a crystal ball. So let's land the plan. Over 10 years, VOL won, carried by a historic tech run turning $100,000 into roughly $427,000 versus SCHD's $336,000. But in 2026, the tide turned, and as of this recording, SCHD is up around 17% against VOL's 10, doing exactly what it was built to do when markets get nervous, while paying you 3 times the income the whole way. Same 2 funds, 2 completely different jobs, and the right one depends entirely on what you need your money to do. If this gave you a clearer way to think about your own portfolio, do me one favor. Tell me in the comments which one you actually hold, SCHD, VOL, or both. I read every single comment. It's genuinely what tells me which deep dive to do next. And if you want me to take this further, I'm putting together a full breakdown of whether holding both and in what specific split actually beats picking a side. Real numbers, back-tested. If that's something you'd watch, let me know below. Until then, invest based on what you actually need, not on what's loud this week. See you in the next one.